All right, on to our first speaker. We have Tim Sparks from Vanguard. Vanguard has been helping investors meet their long-term goals with low-cost investment solutions for over 19 years, with a reputation as a global leader in client advocacy. Tim will be speaking to you guys all about exchange-traded funds and the investment market. So if we can get a round of applause for Tim.
Thank you very much. I'm Mike Duff. Can you hear me up the back okay? Yep. Thank you very much for having us here this evening, and thank you for taking time out of your schedules to hear a little bit more about exchange-traded funds. I've been working at Vanguard for about 4 years now, and prior to that I was with Barclays Global Investors and got a good opportunity to work with two of the major providers of exchange-traded funds in the world, and I thought that I'd share with you some of the most common investment requests or investment ideas that we get across our desks on a daily basis. And I've broken that up into thematic investments. If you want to invest into the US, take a particular trade, or if you want to build a particular asset class, or if you wanted to put together a holistic portfolio solution using exchange-traded funds. So a couple of, or 3 ways to use ETFs and some genuine takeaways that you can discuss with your investment advisors. So a little bit about Vanguard. Not a huge brand name down in Australia, very big over in the US. Vanguard, as a funds management firm, is taking on board 9 out of every 10 investment dollars in the US at the moment. Gathered $410 billion in assets last year. We're on track for that again this year. And one of the main reasons for that is Vanguard, it's structured differently to other investment management firms. It's a mutual structure, and we run the business at cost. So anything that's every 2 weeks, Vanguard incurs costs, and anything that's left over gets put together and handed back to investors at the end of the year. And what that means is that our average management expense ratio across the planet is about 12 basis points, and our competitors is more like 80 basis points. And so that difference between us and our competitors, that money, stays in your investment portfolios, and that seems to be resonating with investors. 40 years we've been around. We've been around for 21 years in Australia. Head office is down in Melbourne. There's 400 crew members there. 4.6 trillion in assets under management. You may find it interesting to note that it's not just index funds, so funds that track a particular benchmark. It's also actively managed funds as well. Our focus is on low cost, whether it's active or passive. 750 billion in exchange-traded fund assets, and what we're seeing is compounded average growth rates in exchange-traded funds significantly higher than in managed funds. And so we're starting to see exchange-traded funds, the convenience of ASX execution, taking over some of the incumbent investment vehicles. 20 million clients worldwide. We've got about 14,000 crew in the US, the UK, and across the Asia-Pac region. So the investment market's providing us with a lot of things to think about at the moment, and whether it's a US election, whether it's Brexit, whether it's talking about slowdown, clients, fragile interest rates, volatility, there's something that we hold very close to in terms of what we believe in our philosophy, and that's staying in tune with your long-term investment objectives. And an interesting slide on that, what this shows is investment markets 24 hours after Brexit was announced, and then 3 weeks after Brexit was announced. And so if you paid attention to all of this noise, all of these news articles, you wouldn't have a lot of time to sleep, because if you're acting on news on a 24-hour basis, it's not going to do your long-term investment objectives very well. In terms of our outlook for the market, we're spending a lot of time educating investors on historical returns are unlikely to be achieved in the future. And so over the last 30 years, we've had the benefit of 9.6% growth in Australian shares, and that's pretty good. But what we're expecting over the next 10 years is around about 6 to 8%. And so what we're doing is just resetting clients' expectations on what asset classes will return in the future. What that means across different investment portfolios is that if you've got a conservative portfolio where 30% of the investments are in growth assets and 70% are in income assets, we're looking at around about a 4% return over the next 10 years. Over a growth portfolio where you've got 70% of the assets in growth assets, so equities, international equities or domestic equities, 30% of assets in income, looking at about a 7% return. And so what we're seeing is investors do one of two things. They're either resetting their lifestyle expectations or taking on board more risk. And that's fine as long as you're prepared to accept a greater variance in the possible outcomes of doing that. So exchange-traded funds are being used more increasingly in terms of implementing investment points of view. There's over 6,100 ETFs listed on global exchanges now, 4 trillion in assets under management, and forecasters, Morningstar researchers believe that that's going to be double by 2020. In Australia, 137 exchange-traded funds listed on the ASX, 22 billion June 2016, that's about 27 billion now. And so ETFs are no longer the new kid on the block, they're a mainstream investment vehicle. What we're finding with ETFs is they're not replacing managed funds or replacing a direct stock share portfolio, they're simply being used in conjunction with both of those investment vehicles to help clients and investors get better outcomes. One of the reasons why exchange-traded funds are taking off is there's a disillusionment with the value proposition around active management. So active manager, I'm going to pick all the best international stocks. I'm going to charge you 130 basis points to be part of my managed fund, and I'm going to try to outperform the index. And what this shows is that in each of these asset classes, whether it's Australian equities, whether it's small cap, whether it's international equities, whether it's Australian bonds or Australian listed property, active managers, except for the small cap universe, find it very difficult to outperform the benchmark over time. And so if you're telling your investors that your value proposition is to outperform the benchmark and you're charging a premium for that, investors en masse, not just in Australia but across the planet, are exiting active management and going into index management, and ETFs are a beneficiary of that. One of the reasons why ETFs are a beneficiary is because the costs are much lower. So there's not as much work involved in terms of tracking a particular index rather than developing big research teams to try to outperform a particular index, and so ETF providers will charge you less. The average ETF fee across Australia, 48 basis points, and the actively managed fund business is 115. And so if you're saving from age of 40 through to 70 years old, if you're saving $5,000 per year for retirement, or keeping costs from 115 basis points down to 48, what you're going to find is there's going to be $174,000 difference by the time you reach retirement. And so keeping costs low, keeping more money in your investment portfolios over time is something that's driving ETF growth. So with that, we'll bring it back to the benefits and then I'll hit solution mode. So main benefits of exchange-traded funds in your portfolio is low cost, cost-effective, diversified, tax-efficient, liquid, transparent exposures. Core benefits of exchange-traded funds, and that's predominantly what's driving their usage across the investment landscape. So around the world in 3 trades, what I'll do is, as I said, I'll build out a thematic portfolio. I'll build a couple of different asset classes and I'll relate it to some very common types of clients that we see using these. And we'll also look at holistic portfolio construction using ETFs. So the first one, something that's been really popular, VTS, 3,600 stocks, 99.5% of the US equity market, and you can trade that in one trade with the convenience of ASX trading. It's gone pretty well. Over the last 2.5 years, returns have been around about 70%, and it's been a very popular trade for people who are bullish US equities. I think US equities are going to go up, and I think that the Aussie dollar is going to go down relative to the US dollar. Anyone that made that trade within the last 2 years has predominantly been right. Something else that we're getting a lot of phone calls about right now is trading into developed Europe. So 20 economies across developed Europe, getting access to countries and economies like Switzerland, the UK, France and Germany, building out geek sectors that are poorly represented on the Australian Stock Exchange. So if the Stock Exchange is a very big banking sector, very big resources sector, industrial sector, well then buying into these type of economies give you the opportunity to diversify away from that. The third one, VAE, regional Asia. So buying into companies like Samsung, Taiwan Semiconductors, all with the convenience of ASX trading. And I'll put a question to you. Out of those three particular trades, US, Europe or Asia, which one do you think has gone up the most since the 1st of January this year? US? We've got a lot of Europes today in some of our other meetings. It's actually regional Asia. So up 14% since the 1st of January. And that's a trade and an investment that's falling under a lot of investors' radars. So you can trade the US, you can have a particular view on each of these regions across the planet, or you can use all three of them to build your international equity portfolio. And you can take a view by dialing up or dialing down Europe relative to Asia, relative to the US. And here's where we start to see what's essentially a passive investment tool being used in a very active way. Does that make sense? Flexibility and control. The investment decisions are coming back to you and you're implementing those via the ASX convenience of ASX trading and settlement. So we'll move from thematical trading over to building a particular asset class. I want to introduce you to John and Eleanor, mid-50s. Current portfolio is composed of domestic equities and cash. The research that we're doing into the self-managed super fund market in Australia tells us that a lot of portfolios are overweight domestic equities and cash. What interests me is that if you're building an investment portfolio, you've got two choices. One, you can go to an industry super fund and you'll get an institutional grade multi-asset class portfolio, or you can build out a self-managed super fund. And the huge amount of people that are building out self-managed super funds are highly concentrated into basically 2% of the global investable universe and vastly overweight two asset classes, domestic equities and cash. So when this type of client does go for advice, more often than not, we see it starting with the building out of an international equity portfolio. And you can do that with two trades, with VGS, which is Vanguard Global Developed Markets, and also VGE, which is Global Emerging Markets. And so with those two trades, if you had $10,000 to invest and you put $9,000 into global developed markets, you put $1,000 into global emerging markets, you'll get a very strong correlation to a popular international equity benchmark. And so the MSCI All Country World Index is one of the most well-known international equity benchmarks. And any active manager who's out there trying to pick all the best stocks around the world and outperform will more often than not benchmark themselves to that index. Now you can build that with two trades. You can do it for 21 basis points. An active manager might be charging you 120 basis points. And this is the performance of that index over a 10-year period. Kind of interesting if you remember going into the depths of the GFC, international equity returns muted as the Australian dollar fell versus the US dollar, and then we've seen some pretty good returns over the last 3 years. What worries me about this chart is that around here is when we started to, it was up 25, international equities were up 25%, and so we were asked to present on international equities in pretty much every presentation that we did. Whilst performance is important, I think it only tells half the story. Because if you accept from me that a lot of portfolios are concentrated in Australian equities, what I've got here is, I'm using an ETF, it's VLC, which is a large cap ETF, it's 30 of the largest stocks on the ASX, and it has risk levels that's broadly in line with many self-managed super fund investment portfolios that are holding Australian equities. And so if we take 30 of the largest stocks on the ASX and we add in those 2 international equity trades, what we're doing is adding in over 5,500 individual stocks across 40 developed and emerging market economies. And so it brings the level of risk in the portfolio down by about 24%. And so you may be wrong on international equities continuing to go up, but the benefits of that diversification through 2 ETF trades to complement what you're doing in Australian equities is something that we'll carry forward year on year, and it will give you a smoother ride during times of severe market dislocation. Got a choice there as well, so you can dial up or dial down emerging markets relative to developed markets, so there's that flexibility and control. And there's also a hedge version where you can swap out developed markets unhedged for developed markets hedged and take a view on currency too. So there's flexibility in decisions that you can make. You're bringing those in-house and building out that international equity component. So that's one asset class. I'll switch gears and we'll move into fixed income. So same couple, 5 years later, I've used the same photo, you'll have to believe me. It's early 60s now, 5 years down the track. Current portfolio composed of domestic equities, international equities and cash, and they want investment advice on the benefits of fixed income. So 2 international fixed income ETFs that I'm using there, VIF and VCF. I'm building out this slide in exactly the same methodology that we built the international equity benchmark, a very popular international equity benchmark, Barclays Global Ag. If we use those 2 ETFs, same $10,000, 6,500 into international fixed interest, 3,500 into international credit securities, you get the very strong correlation to that popular international fixed income benchmark. So 10-year performance, been very good, but let's have a look at the risk side of things as well. And I'll just recap. We started with a 30-stock Australian equity portfolio. We added in international equities, and now we're adding in international fixed income. And I'm sorry that I've thrown a lot of acronyms at you in the last 15 minutes or so. This is the last one. We'll pop in Australian fixed income as well. And what this does is it starts to look a little bit like a conservative, a growth portfolio for an Australian investor, where you've got 70% of your assets in equities and 30% of your assets in fixed income. So same chart, we started off with VLC, large cap Aussie equities. We reduced the level of volatility or the level of risk in the portfolio by about 24%, and we add in fixed income and we reduce the level of volatility in the portfolio by almost half. So this portfolio here has over 10,000 stocks and bonds, again across 40 developed and emerging market economies. And we shouldn't mistake simplicity with the lack of sophistication, because you're getting a self-managed super fund portfolio moving down much closer towards what you'd get if you went down that industry super fund route, which is a multi-asset class institutional grade model portfolio. We did that with 5 trades. So you start to see in international equities or international fixed income benefits of diversification, one of the drivers of ETF usage across the planet. So the last case study before I hand over, Sam, early 40s, has 280,000 in super, invested in stocks and cash, and wants a holistic model portfolio. At Vanguard, we build out, we've got an investment solutions group team, a global team, consists of about 16 CFAs and PhDs that just work on what is the best multi-asset class portfolio methodology. And then we have teams that sit around the world that localise that methodology for local tax laws and home market bias. And so in Australia, we get benchmarked, these managed funds that we produce get benchmarked against industry super funds, and there's about 65 of them. And regardless of the time frame and regardless of the risk profile, we're top quartile performers. And the main reason for that is that we were able to keep costs low and keep more money within those investment portfolios. The reason why I'm talking about managed funds in an ETF presentation is that you can build those with managed funds too. And so with the variety of exchange-traded funds on the market across these different asset classes, you can build out those same model portfolios, depending on what risk profile you are, with 7 trades on the ASX. And here's where I'd reiterate, not mistaking simplicity with a lack of sophistication, because there's a huge amount going into the delivery of these exchange-traded fund vehicles and a huge amount going into these asset class weightings. And the result for SAM is, if you remember that the average MER is around about 120 basis points, well then you can now access, through ETFs, a portfolio like this for 13 basis points, keeping more money in your portfolio over a longer period of time. That's the high growth. We also have the other risk profiles, that's an example of how exchange-traded funds are used in investment portfolios, and it's incumbent on you all to speak to your advisors to work out which risk profile you are. So just in finishing, I'll again point to some research that we've done in self-managed super fund market in Australia, overweight cash and also Australian equities, and this is what the average self-managed super fund portfolio looks like. Let's have a look at what happens when we add in Australian fixed income, Australian equities, international equities, and also some property. And we're going to do that with different weights, 17, 33, 50% ETFs, and then 66% ETFs. This is kind of a cool graphic. Out of all of those portfolios that gave the average asset allocation, we looked at the Australian equity component, and we found that there were 3 main portfolios. One was focused on high yield, one was focused on large cap, and one was focused on not too much at all, sort of discombobulated stock selections throughout the ASX. 18 stocks on average, and 10 of those stocks were all very similar. Now, as fund managers, we get a little bit obsessed with the efficient frontier. It's a way of measuring risk, it's not the only way. But what I'm trying to show here is that the closer you are to this line, you're getting the appropriate amount of return for the risk that you're taking on board with an individual asset class. And from these self-managed super fund portfolios, those people up the top there, fantastic, absolutely shooting the lights out, doing really well. People down here, not doing so good. So let's see what happens to these portfolios when we add in those different components or ETF trades. So that's with 17% ETFs, 33% ETFs, 50%, and then 66%. So you're getting these portfolios through the benefit of adding in over 10,000 stocks and bonds, much closer to the efficient frontier, where you're taking on the amount of risk, but you're getting an adequate return. So just summing up, ETFs move portfolios closer to the efficient frontier, simple yet highly sophisticated, and excuse me, genuine diversification in just a few trades. So we've got, we did focus a little bit on international equities. We've got fixed income, property, Australian shares, international shares, and also, excuse me, a website that I'd encourage you to source some information on if you did want to go into detail on anything that I've spoken about today. So with that, I will say that what I've spoken about today is general advice, certainly not specific, and please have a look at our website, speak to your advisor, and we'd love to support you where we can. So with that, I will thank you very much for your time and hand over to, who am I handing over to? The
Bruno.
MC. All right, thank you.